SVB. Know what it stands for? Well, I'm sure we all do now. It's Silicon Valley Bank, but I bet we didn't until last week when it went bust, taken into administration on Friday. In fact, it's the 16th largest bank in the US, primarily tech-focused, a very specialised business. What does that mean for the rest of the market? Lawrence?
Well, David, as we saw yesterday, the regional banks in the US all took a hit on the back of that. The word we're looking at is contagion. We've heard it before, back in 2009 with the credit, 2008-9 with the credit crisis. So, yeah, on the back of what happened with SVB, we saw regional banks down between 10 and 60% yesterday. The European sector, European banks also took a hit, 5-6%, and the other bank now that everybody's looking at is Credit Suisse. Credit default swaps yesterday hitting record highs. People now looking at thinking, what's going to happen with Credit Suisse?
There's been some talk, there's a lot of chatter around the contagion within the banking industry, because in one way it looks like SVB was contained. But I mean, Silvergate, which was basically a bank which was a savings and loan, which was basically a building society not that long ago, and then it sort of turned its attention to crypto. Now it's really suffered. We've had this sort of tech recession, we've had this tech crypto meltdown, and so you've got to worry about that sector. These regional banks are less regulated than the top tier. Are we going to see contagion across the whole of the banking sector? Or?
I would probably guess not, David.
Yeah.
I mean, yeah, we saw a negative reaction yesterday, as alluded to earlier. But there's a lot of procedures in place now to stop this. After 2008, 2009, a lot of procedures put in place to stop the contagion. Obviously, it can happen. As I say, Credit Suisse is the new one. Everybody's going to be looking at now. But the market reaction today has been muted. These regional banks are now being called up between 10 and 20%. Okay. So it looks as though, for now, it looks contained. Yeah. But obviously, we'll see.
Indeed. And I mean, one of the things playing into this, one of the things that hurt the tech sector last year in particular is the rapid increase in interest rates.
Yeah, indeed.
And this is where we find ourselves. We're just a week away now from the Fed's next decision on rates. What a change around we've got, though, in expectations for that. Can you take us through that a bit?
Yeah, well, obviously, as we saw last week, after Powell, his two-day testimony, the markets were pricing another 50 basis points hike on the basis of what he said, that rates will be here for longer, higher and longer. Now, we've had a reversal. It looks as though now, well, we saw Goldman's come out and say, we don't expect a hike next Wednesday. Nomura say they think there might even be a cut next Wednesday. Overall, the market is saying there'll be a 25 basis point hike. Maybe then we might think about having a pause, but we'll see.
What would you think the market reaction would be, though, if the Fed were to cut rates, like Nomura say?
If the Fed cut rates, they will lose credibility, full stop, because they lost it on the way up, because they said it's transitory. The market didn't believe them, but they stuck by it and they were wrong. Now Powell, as I said, has said that we're going to stay higher for longer, and if he suddenly does a 180, and they cut, the market will look and will say again, well, you don't know what you're talking about. Simple as that.
Lawrence, thank you very much.
Pleasure.